Sea Limited is a hypergrowth stock that has crushed the market since coming public. But like many high growth stocks, its share price has been under tremendous selling pressure recently and is currently down more than 65% from its 52-week high. This is a stock that I've admired from a distance for a long time, but is the thesis for owning this company busted? Here's everything you need to know about Sea Limited. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to StockCard.io for sponsoring today's video.
Brian, despite falling so much, Sea Limited is still a $68 billion company and it trades under the ticker symbol SE.
Sea Limited's mission statement is to better the lives of consumers and small businesses with technology. That's simple, inspirational, and optional. This is a company that gets mission statements.
Brian, I agree. And we're going to focus on that last one, which is optionable, because this company has three different business segments. The first one is Garena. That is a gaming platform, and the company has an in-house developed game that is a huge hit called Free Fire.
The second business is called Shopee, which is an e-commerce platform similar to Amazon, eBay, and Mercado Libre.
And the third product is C Money, which is a fintech payment option similar to Mercado Pago or PayPal. Now, importantly, Shopee and C Money are primarily focused on Southeast Asia, so countries like Taiwan, Indonesia, the Philippines, not China.
Now, historically, all three of these business units have been on fire and have remained in very high growth mode. However, more recently, Garena has been struggling.
Now, there's a couple reasons for that. One of them is that as economies and societies open up, people are spending less time playing games. We've seen that happen with many gaming companies, so it's not a huge surprise. Another part of it, however, is that it has been kicked out of India, which is its largest potential market, but not its most important one from a profitability standpoint.
But I think it's fair to say that the slowing growth in Garena has been a major reason why this stock has been under so much selling pressure.
Now, if we turn our attention to e-commerce, we see very few signs of slowing down. The number of orders has almost doubled over the past year, and gross merchandise volume, or the value of all the stuff sold on Shopee's app and website, is up 53%. These are very strong indicators that the company is taking market share primarily in Southeast Asia.
Now, the company's third division, Sea Money, continues to show no signs of slowing down. Quarterly active users recently grew 90% to nearly 46 million, and total payment volume continues to skyrocket.
So when we look at the company's business model, you can see how it's a little bit complicated. You have a gaming division, you've got an e-commerce division, and you've got a fintech division all rolled up into one.
Now, when we think about customer acquisition costs, Sea Limited is still spending very, very heavily to acquire new users across all three of its platforms, so its customer acquisition costs are currently very high.
Now, when it comes to gaming, e-commerce, and fintech, those things can be fairly recession-proof. However, we give this a medium rating because of the pullback in spending on Garena and the fact that once it reaches maturity, a recession could hurt the e-commerce division and fintech as well.
On the plus side, when it comes to gaming, marketplace, and payments, all three of those businesses tend to benefit from high levels of recurring revenue.
Now let's talk about the moat for a minute. The network effect is very strong here across all three divisions. Free Fire is a multiplayer game that you can play with your friends, so there are some network effects there. For Shopee, the more customers that are on the platform, the more merchants are incentivized to join, and the more of them that join, the more customers that flock to the website. It's a reinforcing loop. And the same is true for C Money. The more merchants that accept C Money as a form of payment, the more people that are likely to use it in the future.
We also think that Sea Limited benefits from high switching costs. There are some switching costs to gaming, but the higher switching costs are really from the combination of the marketplace and the payment platform working together.
Now, when it comes to low-cost production, the primary way that Sea Limited could have this is by having a fulfillment network that allows it to send packages at a lower internal cost than the rivals. But the company is currently at the build-out stage of those fulfillment centers right now, so we give it a low rating for now.
We also think that Sea Limited is starting to benefit from branding. The Shopee app is the #1 most downloaded app in Southeast Asia and is rapidly rising the charts in places like Brazil.
If you put all of these things together, we both believe that the moat surrounding all three of these companies is expanding rapidly.
Turning to the company's financials, this has been a top line growth story, and man, oh man, has the growth been good. Over the last 3 years, the company's top line has grown at over 100% per year.
At the same time, gross margins haven't been what we'd hoped for. Currently, they sit at 39%, but that's because right now, Shopee and C Money aren't money-making ventures.
Now, the top line has looked great. The bottom line, not so much. This company has producing a net loss that has widened over time.
At the same time, free cash flow has actually been positive, if by a small margin. And that's a huge benefit because the company can continue to fund its aggressive investments.
Meanwhile, the company's balance sheet is in really good shape with almost $7 billion in net cash.
But since net income has been negative and growing larger, returns on capital are currently negative.
Now, it's worth diving into the composition of those sales. As this chart shows, Garena and Shopee are currently the lion's share of revenue, with C Money making up just a tiny bit. However, C Money is the fastest growing division.
It's also really important to understand this dynamic. Currently, Garena is funding all the future growth that can come from Shopee and C Money. That's because on an adjusted EBITDA basis, it's the only money maker. That also explains why, when the company announced that it was losing some active users for Free Fire, the stock fell so much.
Turning to management, this business was founded by Forrest Lee, who is still the chairman and CEO today.
If we take a peek at Glassdoor, we see generally good reviews from employees, but we want to note that there are only a very limited number of reviews available on the site.
But we do know that inside ownership at this company is very high, with insiders owning nearly 34% of the company, which is worth $21 billion at today's prices.
So, does C Limited have optionality? Absolutely. With the exception of perhaps Amazon.com, no company has been able to go into so many industries and execute on their ability to capture market share.
Yeah, it's one thing to launch new businesses, it's another thing entirely to scale them as well as this company has and grow its revenue so rapidly in them. Meanwhile, there's also reason to believe that this company's net income could improve dramatically once it starts focusing on profitability, because right now operating leverage is working against this business.
One of the reasons that the company is willing to spend so much on Shopee and C Money is because the potential market is enormous. No one has actually put a number on it, but it's definitely in the hundreds of billions of dollars, and it could even be pushing a trillion.
One other thing that's worth noting is that all three of those business lines are homegrown, so the vast majority of this company's revenue is organic in nature.
So, how's the company done against Wall Street's expectations? Well, even though it's down 65% from its all time highs, it is still absolutely thumping the market since coming public.
As far as meeting Wall Street's short term demands, the company doesn't focus on that at all. Over the last 4 quarters, the company has missed Wall Street's estimates.
And unsurprisingly, given where it is in its growth cycle, C Limited is not returning any cash to shareholders.
Now let's focus on risks, and boy, are there a lot to keep in mind. First and foremost is competition. There is tons of competition in all of the categories that the company competes, including Lazada, Alipay, and many, many others.
Dilution is also another thing investors need to keep an eye on. The company had many secondary offerings when the stock was much higher, so it could fund its future growth.
It's also worth pointing out that this company's financial statements are complex, so this is a medium difficulty business for the average investor to understand and follow.
Because C Limited has operations spread throughout the globe, though most are in Southeast Asia, it's worth noting that there are always going to be inherent geopolitical risks with investing in the company, with the recent decision by the Indian government to kick Free Fire out of the country as an example of these risks.
It's also worth noting that Garena is what's funding the rest of the company right now, and video games are a hit driven business. Free Fire is one of the most popular games in the world right now, but will that always be the case? That's hard to tell.
Another thing that we like about the company right now is we're able to get shares for cheaper than we have in at least 2 years. Right now, shares trade for around 7 times sales, which isn't a great deal, but much better than where the stock has been recently.
So, what should investors watch to tell if the thesis for the stock is on track? First, keep an eye on Garena's gross profit. This is the engine that fuels the rest of the business, and we want to see this number remain stable and continue to grow.
Second, keep an eye on Shopee's gross merchandise volume, or the value of all the things sold on the company's marketplace. We want to see the number of orders and the gross merchandise volume continue to grow at least a 40% rate.
Third, keep an eye on C Money's total payment volume. This is an indicator that C Money is continuing to grow within its user base, and we want to see this business continue to thrive. So, how did C Limited score in our investing checklist? The answer there is great. On mine, it got an 80, which is particularly impressive given that this company has not met Wall Street's estimates and is not currently producing net income.
And on my framework, this got a score of a 13, which is in the anti-fragile area. That's because I believe that this is a founder-led, mission-driven, wide moat business that has demonstrated optionality.
All right, Brian, we just made our public call, so we're going to be giving this the thumbs up in our stock card portfolio, and I'm going to be adding it to my personal portfolio soon too. Let's head on over to stockcard.io. We're going to open up our portfolios. We're in the anti-fragile portfolio. We're going to place a new order. The ticker symbol is SE. We're going to do a buy decision. We're recording this on Thursday, March 24th. We're going to be buying 9 shares. The stock is currently at $120. And this for you is a score of 13. Then we're going to head on over to my quality checklist, and we're going to be doing the exact same thing.
And while Brian does that, we want to remind folks that you can head on over to stockcar.io and register with the site, and you can view these portfolios for free so you can see how we're doing. At the same time, we encourage you to join the Beat the Bryans contest, where you pick 5 stocks that you will think will do the best in 2022. Beat us and you have bragging rights. Finished in first place and you can win a $1,000 prize.
There you have it. We think C Limited is a high quality business that's on sale. That's why I'll be buying shares. Brian's out.